It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm also one of the certified financial planners on the program, also your host. With me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
More and more people have an HSA-eligible, high-deductible health plan. Could be through work, could be through the marketplace, your own private plan. If that's you, if you're eligible, we sure hope you're funding an HSA. And as much as we love to talk about the tax benefits, there's also some tax traps.
Yeah.
So we're going to help unpack those today on today's episode.
That's right. There's nothing worse than a tax surprise, like a negative tax surprise. Just can't stand it. We're going to help you avoid some of those.
I can think of a few things worse, Mike. Just for the record, I'm not trying to
But
be...
it's on the list, Kevin. But it's close.
I'm not campaigning to be the mayor of Litteralville here, but I can think of a few things.
All right,
worse.
that's fair. That's fair enough.
Okay.
The plan is to get to questions from fans of the show. We've got a long list. We're hoping to hit that. We'd love to hear from you. You can call or text us, 574-222-2000. That's 574-222-2000. Online Wise Money Show. You can submit questions right there. And then all over social media, most questions come on the YouTube channel. Wherever you're at, we are there as well. All right, so do you have an HSA plan? Ding, ding, gotcha. So listen, it's a high deductible health plan that's HSA eligible. And gosh, guys, remember like way back when, high deductible, that's always a relative term. Mm-hmm. But it used to be that, well, listen, if your deductible is like $3,000 or higher, then it's going to be HSA eligible. Not anymore. Not anymore. You can have very high deductible health plans that are not HSA eligible. But if you have an HSA eligible high deductible health plan, you can fund an HSA. That's not use it or lose it. We're going to talk about those details first. Tons of tax benefits, but there's some tax traps. We're going to hit 3 scenarios you need to look out for as you get close to Medicare and into retirement. But let's first set the stage. We've done this several times. A couple shows ago, we did this. The details, the basics of the HSA. How's it work?
Well, think of the HSA as just an account that you can put money into that you're pre-planning to use for some sort of medical expense. Now, that could be medical expenses that you run into this year. As you fund the account, you immediately pull the money right back out to pay for those medical bills. Or there's actually ways that you could take advantage of the HSA to fund medical bills out there in the future. Mm-hmm. You could even reimburse yourself for medical expenses today out there in the future. So there's actually a lot of flexibility in this thing, but not everybody is eligible, right? You have to be a part of a high deductible plan that is HSA eligible. There's very specific language and requirements that go into that. And if you're signing up for your own private health insurance through the marketplace, you would want to see right on there in the title of the name, this is an HSA eligible plan. Or if you're working for an employer that has a group plan, you want to know, is this high deductible plan, is it actually HSA eligible? So you can take advantage of this tool, of this account in your own planning.
So you set up if you're eligible, if you've got a eligible high deductible health plan, you can set up a bank account. Oftentimes your employer, HR, is going to have an easy way for you to do this. That might not be the best one, but we can get into that. But set up a bank account where the money that goes in is pre-tax. If it's coming right out of your paycheck, it avoids federal tax, state tax, and even FICA tax. So those dollars actually aren't calculated in your Social Security benefit because you're not paying Social Security tax on them. So not a big deal, but something to be aware of. So when you fund it right out of your paycheck and goes directly into the HSA, that bank account, then you're avoiding federal, state, and FICA tax. The second way, though, is if you aren't funding your HSA out of your paycheck, then you fund it right from your checking account or whatever, and then it's a deduction on the front page of your tax return, still avoiding and saving you federal and state taxes. So that's how it works. It's not use it or lose it. This is your account. It's your money.
That's right. This money could sit in the HSA for months, days, weeks, years,
Yeah.
even decades, right? So you have flexibility on when you draw the money out to reimburse yourself for those medical expenses. You also have a little bit of leeway on when you fund it. Obviously, if you're contributing to this account every pay period right out of your paycheck, then you want to set this up at the beginning of the year, put it on autopilot, and by the end of the year, you will have funded exactly the amount that you intended to contribute. The other option is to contribute out of cash you already have on hand, as Mike was describing, and you actually have up until April of the following year to be able to fund that. So sometimes people will use the HSA contribution as kind of a last-minute tax planning tool when you're preparing your taxes. I'll do this often with my CPA. We'll get a draft of the tax return done, and then we'll have a conversation about, okay, is this going to be another year where we want to max out that HSA, or is there kind of a sweet spot on how much to contribute? So you have some flexibility even on the timing that the money goes into the account.
Speaking of what you can contribute, the IRS sets those limits, of course. And again, you first need to make sure that you're eligible. But after that, if it's an individual plan, then you can contribute up to $38.50 this year, and that includes any employer contribution. So if your employer is contributing, then that counts towards that limit. On the 401k, any match doesn't count towards your limit. So this is another one that's just sort of weird with the HSA. If you've got a family plan, then your contribution limit is $77.50. There is a catch-up contribution with the HSA as well, but it works unique in two different ways. Number one, the catch-up contribution starts when you turn age 55, not age 50. That's number one. And then number two, the catch-up is $1,000 per person, right? But your $1,000 typically you look at an HSA and you think, well, that's our money if you're married. That's a joint account. It's not. Yeah. It's just whoever opened it, okay?
That's right.
So if that person, that individual can do an extra $1,000 of that one, but if the spouse who didn't open the HSA, if they're 55 or older as well and also on the plan, they can open their own HSA and throw $1,000 into that as well.
And I had to learn this the hard way. Like this is some of the battle scars that I've accumulated over the years. When these first came out and the catch-up contribution was available, I remember a couple that they were both retired and had their own health insurance plan. They were both eligible to contribute to the HSA and do a catch-up. And so we sent them off to the bank and said, okay, go max out the family contribution and do $2,000 as catch-up contributions. And they came back and said, no, the bank won't let us do that. They'll only let us contribute $1,000. And I'm like pulling my hair out thinking, no, I'm confident you can each do $1,000. We need to, do a call, or we need to kind of push back on this, and just could not get the bank to budge. And it wasn't until like a year later that we realized, the bank was requiring that the second spouse open their own HSA to do their portion of the catch-up. So they had to open a second HSA just to throw $1,000 into it. Makes no sense. Why can the family contribution go into one account but not both catch-ups?
Oh, there you go again, Josh, trying to make sense of all this.
I'm actually surprised, Josh. I remember when that happened. It was a long time ago, and we had been working with HSAs and giving advice on them for a while, but most of the rest of the world wasn't. And banks in particular didn't have a clue how these things worked. And so we would, just to give you the benefit of the doubt, Josh, there's several instances where we would give instructions to the client or to the bank, and the bank would say, oh, no, that's not right. No, it is right. Okay. One of the things you need to watch out for, because I still see this today, is even if you're contributing to your HSA up until that tax filing deadline for the previous year, you've got to make sure it's explicit that, hey, this contribution's for last year as opposed to for the current year. Because from January 1 until April 15, you can contribute to your HSA, and it could be for the current year or for the previous year.
That's right.
And if the bank doesn't know, they'll make an assumption. And if they make the wrong assumption, you got big problems.
And that's often when I fund my HSA. So I have to physically go to the bank, fill out a form, make sure that this contribution is going in for the prior year. because I've had it get messed up before.
Yeah, we have too. And when you over contribute to the HSA, we're going to get into these scenarios in a second. It's easy to fix, but it does take some time and obviously some awareness. Otherwise, there's penalties and there's some challenges. So with that backdrop of how the HSA works, so easy, right? What are some tax traps? And yeah, all these unique rules, those weren't the traps. As you get close to retirement and in retirement, there are some specific tax traps that we want to help you avoid and plan around. There's 3 of them that we're going to help you with. So we've got that and more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. You're at the Wise Money Show channel. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern Time, every Saturday morning, and also on podcasts at the same time, and also on a couple local radio stations here in northern Indiana, southern Michigan, where we're headquartered. All throughout the work week, though, we've got lots of additional content that airs right here on this channel. Next Wise Step videos taking a certain concept, how to protect against inflation and how to plan for retirement, those sorts of things. What happens if you retire earlier than you had originally planned? How do you get through that? So those sorts of things and a lot more airs right here on this channel. Make sure you hit that subscribe button, turn on notifications so you're aware every time we drop new content. And if you like the content, Thank you very much.
Good.
10:15, not 9:15.
Yeah, I know. I was stuck back in the pre-hour-long days.
Yes.
And I had a little panic attack there.
All right, so scenario number 1. We're going to hit that right now.
And I've had clients show up age 67 saying, because they're on Medicare, Social Security, the whole 9 yards, at 67 saying, oh, and we did fund our HSA this year.
Yeah.
I'm like, well, actually, you're not eligible. I'm like, well, we went to this this union that gives credit to teachers, and they let us do it. And so
yeah, that's the thing. I mean, I'm glad you shared that story, Josh. And yet at the same time, I certainly wouldn't want to portray that. And this is going to sound mean. It's not mean, but that the bankers know all these rules and will tell you when you can and tell you when you can't. They don't know.
I know. The dirty little secret is it's not on your banker. It's
Correct.
On you.
Right.
That's the problem.
The bank system was set up properly. It wouldn't allow them to get that extra $1,000 into one account.
Yeah.
But no one could explain why.
Yeah.
So, and that was early on, and I think people get it better today.
Yeah. All right, here we go. Scenario number 1. All right, there's some issues with the HSA, contributing to the HSA, and Medicare. Now, there's great advantages, but there's some tax traps that you need to watch out for. We're sharing those right now to help you plan around them. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, and then all over social media, wherever you're at, we are there as well. So the HSA, fantastic plan. And I don't have the percentages, but gosh, 20 years ago, maybe 10% of the workforce had HSA plans, high deductible health plans. It's maybe 50% now. It's definitely a larger number. Mm-hmm. And so more people are funding HSAs because they have an HSA-eligible high deductible health plan as they're approaching retirement. But the issue is it doesn't play nice with Medicare. Mm-hmm. And it stems to this issue that, well, are you eligible to contribute to a health savings account and deduct your contribution? The answer is yes, if you have an HSA-eligible high deductible health plan. Not period, but comma. And you don't have any other health insurance. Mm-hmm. Most people leave that out. It's like, well, what's the contribution limit to your Roth IRA? $6,500. No, it's up to 100% of your earned income, or $6,500, whichever is less. Mm-hmm. So this unique thing with the HSA is, well, as long as you don't have any other health insurance. So this prevents you from saying, well, I've got an HSA eligible plan through my employer. Spouse, you have a really low deductible through your employer. So let's each get on both, and we'll fund an HSA, a health savings account, get that deduction, and enjoy the benefits of a very low deductible plan. You can't do that. Mm-hmm. As you approach Medicare, this becomes an issue. So scenario tax trap number 1, You continue working past age 65, but you don't opt out of Medicare Part A, and you're still funding your HSA. Is this a problem?
It is, because that second piece of the requirement that you were just articulating, you can't say that you are not on another health plan. As soon as you have Medicare Part A as part of your coverage package, it makes you ineligible to contribute to the HSA. Now, it doesn't mean necessarily that you couldn't get it done. Like you might be able to still make a deposit into your HSA because the bank doesn't necessarily know what you've done over here kind of on the side. They don't know what you've done with Medicare Part A, right? Mm-hmm. So you could be contributing to the HSA. Everything is working just like it always has, and you don't realize that you're actually making ineligible contributions. That stuff's got to get fixed.
Yeah, that's right. So, I mean, the question is, well, and I've said this before, and I can't believe I'm going to say it on the radio, but I am. How would they know? I don't know. But I do know the rules that you're not allowed to do that. And so making sure that at age 65, when you might automatically be added to Social Security Part A, you opt out, you make sure that you don't have Part A so that you continue to still just have one insurance. That's a HSA-eligible high deductible health plan, and that allows you to still contribute to your HSA.
Yep.
I certainly wonder if over time these agencies, if the Medicare system can start talking to the IRS, if there will be data shared between government branches, so to speak. But for right now, again, like you could actually be compounding the problem. I think, Kevin, you were sharing at a break that some folks came in and they had been contributing years past their eligibility.
Yes. So this is the thing. It's, Mike says, well, how would they ever know? The problem is right now, it's likely that they wouldn't know, and it's a systems issue. So whether it's systems or it's 87,000 new agents, they're working towards knowing these types of things. Yeah. So we all operate in the system of voluntary compliance. We know what the rules are and we follow the rules. That's the way. One of the many ways to have peace in your life.
That is one of the things that makes this country great too.
Yep.
Because that is not true around the world, right? Absolutely. It is. No, how do I get away with as much as possible? Who can I pay off? That sort of thing. And we are a nation of laws, and we do comply on the whole. And that's a good thing.
Yeah, go to a country rich in natural resources and with great ports and every reason to be a wealthy country, and they're not. And you say, why not? Because of corruption, because of the rule of law, fee simple ownership of property, all these types of things. So let's keep America great here.
Within this tax trap of not opting out of Part A, I actually stumbled onto a scenario that, again, is still embedded in this first tax trap, and that is the one individual is working in a married couple. One individual is working, has an HSA-eligible high deductible health plan. Spouse has already retired and is not working and is drawing Social Security. Automatically going to be added onto Medicare Part A. And when I found this out, I said, well, wait a second. I don't think you can contribute the family amount to your HSA. And he said, well, no, so we still have family coverage. I said, I know, but your spouse has Part A. And normally you talk about this sort of stuff and people think you're crazy and why are you making up all these rules? But this individual was aware of this. They had already worked on it with their company and had hired a Social Security attorney and got a ruling that said no, even if the non-working spouse isn't the one that carries the insurance, and yeah, they're covered, but if they've got Part A only, you can still contribute the family amount. I'm not saying that that's gospel. That's what they've found, and so great. But this stuff gets really, really confusing. The big idea is if you are contributing to your HSA and want to continue to do so even after age 65 while you're working, don't get on Part A. Make sure you opt out of Part A of Medicare.
Right, and understand, so because what is this 6-month look back period?
Well, that's trap number 2. Okay, so the second issue, and it connects right to this first one, is, and this one's a biggie. This one's really big. You're still working. So kind of continuation of scenario number one. You're still working past age 65. You've got your group insurance, and one of the reasons, or one of the tax strategies you're doing is, well, I'm still working and I'm not getting onto Medicare so that I can fund my HSA every single year. So then you work until age 66 or 67 or 68. And at that point you say, okay, now I've retired. I'll shift directly onto Medicare. I'll fund my HSA right up until I leave. And then I'll transition onto Medicare. And the big gotcha is Medicare automatically enrolls you 6 months earlier. 6 months earlier, which means you were supposed to stop your HSA contribution 6 months prior to the time you actually retired.
Imagine how messy that can be if you retired on January 1st or something.
Yeah.
And or early into a new year, and they go back a calendar year. They could start messing with tax returns in 2 different years, right?
Oh, absolutely. You've got to amend or something, but basically you've got to fix that. We got a question here just from a couple of weeks ago from a fan of the show who's got that exact same scenario. It was basically saying, this is what I was doing, then all of a sudden I'm met with, I was enrolled in Medicare 6 months prior. Is this the reality? Do I need to do something here?
So here's the scenario. I'm happily working. I hit 65. I don't sign up for Social Security, and I don't do Medicare. I stay on my group plan. I hit 66 in 10 months. Now I'm at full retirement age. I'm still working. I'm happy. I'm staying on my employer's plan. But I say I'd like some extra income, so I'm going to draw Social Security because I'm at full retirement age.
Yeah.
Anytime over 65 that I sign up for Social Security, it goes back 6 months Medicare Part A.
Yeah.
And Medicare Part A and Social Security can't be delinked.
Yeah.
So they are, think peanut butter and jelly. I mean, it's
No, thank you.
It's cookies and milk. They're together and you can't separate them. And that is, I mean, all of these kind of random trivial facts that people need to know and understand, because you wouldn't logically think through this and say, well, of course I'm ineligible for the prior 6 months.
Yeah.
Right. No,
But-
there's no way.
And that change came around in 1983 when they said, listen, when people sign up for Medicare, we're going to automatically push it back 6 months. We're going to make it effective for the prior 6 months. So there's not big issues between hopping off my employer plan and hopping onto.
I mean, at least there
Medicare.
was logic applied to that. However, it creates a lot of confusion, and it's not logical. That's how it works.
Yeah.
So you've got to plan around it. So,
Sure.
All right. So those are 2 of the tax traps. What do you do if you fall into one of those? And what's the third tax trap? We've got that and more coming up on the Wise Money Show with Korhorn Financial Group. All right. Third segment. Going in the third segment. So we'll probably do this segment where we're still talking about this. And then fourth segment can be questions.
It just, yeah. I just don't want to lose everybody.
Mm-hmm.
Because I, even trying to get this straight in my 54-year-old brain, and I'm saying cognitively, my ability to understand complex concepts is not growing at this point. I don't know how to tell you guys that, but in addition to losing muscle mass, my brain is saying, "Will you
Losing brain mass?
dude?" I'm telling you, there's a revolt going on inside this triple XL cranium that says no, 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 no. So,
All right.
This third scenario is really complicated.
right, and I think what folks are craving right now is complexity. So let's.
I think they're craving sarcasm.
Well, I don't think they're craving pauses. So Forgive the filler here, as Mikey B is
We need to get going because he's going to keep talking. He's saying
putting it all together here.
Yeah, I'm looking at questions then to hit and thinking, wondering if we'll get into that in this segment. I don't think we will, but
this is the third
segment.
Why are you looking at questions?
Because you were saying,
Oh, we did get into them.
all right, let's go.
no that we can't move on until you apologize.
Wow. Okay. Apology, Mike. I'm sorry you didn't catch on more quickly.
That's right.
How's that? Is that a good one?
I'm sorry you were offended by my dumb joke.
All right. Here we go. All right, what are some tax traps with the HSA and Medicare? They don't play nice together, and then how do you fix it? We're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast. Wherever you listen, go check it out. Search the Wise Money Show, and then subscribe to it there, and then rate the program at your favorite podcast platform as well. We appreciate that. Okay, so HSA, fantastic tool. It's an extremely versatile financial instrument. It's the only thing that I know of that is pre-tax in, pre-tax out, or pre-tax in, tax-free out. And so if you have an HSA-eligible high-deductible plan, we hope that you are using this thing and working with your CFP to see how exactly you should use it. As you approach retirement, getting your Medicare, it creates some challenges. And we've talked about two of them. This is very complicated, very complicated. The third tax trap is complicated as well. But the root of it is each person technically, so there's one owner of an HSA. There's not a joint HSA account is basically the premise. And Josh sort of warned me before we got into this, hey, this one is really complicated. I just faced it. You might see this scenario as well. Here it is. One spouse is carrying the health insurance for the family. That's reasonable. And that health insurance is an HSA-eligible high-deductible health plan. So they start funding the HSA right out of their paycheck. That HSA, that bank account that was set up is in that person's name. So then when they retire, they have to stop contributing to the HSA. No problem. But the spouse decides to continue that insurance via COBRA or, something else because they're not eligible for Medicare just yet. And if they continue through COBRA, it's an HSA-eligible plan. If they get Affordable Care Act insurance, Medicare.gov, and they choose an HSA plan, then they can continue to contribute to an HSA. So they want it easy. Well, let me just contribute to the HSA that I had before. But the HSA that you had before is actually in
your other spouse's name.
Spouse's name. No one views HSAs as an individual. Like IRAs, don't say that. It's IRA. The I stands for individual. We know that you can't have a joint IRA. But when you're married, everyone's using the HSA. You even both people have a debit card, credit card against it. So why not? It's viewed joint. It's not. It's individual.
That's right. So in your scenario, if the second spouse takes over the health insurance using COBRA, they have to essentially take over the ownership of their own HSA as well. You can't keep contributing to that former spouse. If that eventually gets caught down the road, you've got to pull that money back out. And there are, there's mechanisms in place. There's procedures and forms and things that you could work with your HSA bank to pull contributions back out that weren't supposed to be in there. Mm-hmm. But by pulling them back out, what if you're pulling them back out a year or two later?
Right.
You can't go back and then make the right contribution to the right HSA. And so now you're in a situation where you're amending tax returns. You're going to pay some more tax, maybe even some penalties and things. So this is a complicated enough topic. The point in all of this is you want to get it right the first time.
Yeah.
And, especially at transition points in your life where one spouse is retiring or you're changing jobs or changing health insurance plans in general, you're enrolling in Medicare, any of these types of events, you want to just pause and say, do I know what the tax ramifications are? Do I know what the health insurance ramifications are? And yes, if I've been using an HSA, do I know how the rules are changing because of this transition point in my life? Your certified financial planner, in collaboration with your health insurance expert, you want to have a team of professionals that are integrating the advice that you're receiving together so that these types of details don't get missed.
That's right. It requires comprehensive financial planning, and ideally with a team of professionals so that your CFP is either on the same team as your tax preparer and health insurance advisor, or at the very least, they're collaborating and aware. The point is not, and I think you could receive this, the point is not, well, I'm going to stop contributing to my HSA. That this thing is rife with challenges and traps. No. Don't do that. Figure out, make sure that you understand the rules and you're following the rules. And if you do find out, if this is news to you and, I've done this, then it's actually pretty easy to simply withdraw the excess amount out of your HSA and make sure that it's not something you deduct. You can do that up until your tax filing deadline, and I don't even think there's a form required. You just make sure that you don't over deduct. It's just if you've already done it and you're catching it after the fact, that's where you've got to amend, and it's a little bit more involved of a process.
That's right. The transition into retirement, having this impact that we've been talking about on your health savings account, it's one of the reasons why some people will choose one date for retirement over another as well. I think we've gotten that question a lot. Is there a best time of year to retire? Well, if you're contributing to an HSA, be aware of one of those earlier traps we were talking about. When you sign up for Medicare Part A or start your Social Security and automatically get Medicare Part A, just know they're looking backwards 6 months. And so your HSA eligibility may not have taken you right up. It will not have taken you right up to your retirement date.
I mean, it's interesting because if you retire before age 65, you don't really need to worry about this. But if you retire before age 65, what you do need to worry about is where are you going to get your health insurance from before Medicare, right? So often these traps come in play if you're still working past age 65. But listen, you can plan through it with the right guidance, the right help.
That's right.
It brings me back to sort of this isn't a tax trap, but it's just something that we haven't hit with how the HSA works. And that is, what's your contribution limit? How much are you allowed to contribute to this thing in a year when you have an HSA plan for part of the year? And see, I'm using those terms too. An HSA-eligible high deductible health plan for part of the year, and then you switch on to Medicare for the other part of the year. Or let's say you switch employers, and the employer that your original employer that you started the year with, you had a PPO plan, and then you change jobs, and now you've got an HSA plan. It's pro rata, right? So you take a look at how many months did you have what coverage, and you simply do a fraction. I was helping the oldest child with fraction math the other day.
Nice.
It wasn't nice, actually. That's kind of you to say. We didn't get in a huge fight, but it wasn't fun. But you just apply the fraction to what the annual contribution limit is.
Just wait for algebra.
Yeah, I know.
That's my encouragement to you.
So ultimately, at some point when you retire, whether you are retiring, directly at age 65, I suppose that's probably the easiest. If you retire directly at age 65 and you transition directly onto Medicare, that's probably the most reasonable scenario. But if you're married, that could cause some issues. I mean, guys, just need to be aware.
Yeah.
I mean, this is sort of the crux of the issue. An HSA-eligible high deductible health plan was a rarity 20 years ago. It is being used more and more these days. This is a fantastic tool. We talk about it all the time. Using and funding your HSA, you can think of it for current medical expenses to help you, make sure you're paying those with tax advantage dollars. You could think of that as a retirement account and stuff dollars in it treat it as long-term money, so invest it for your financial future. It's a significant, a big advantage, a great tool. However, it has some issues and some traps with it as you're approaching retirement. I guess a couple other things that I would mention as far as traps, and then we'll transition, is when you're in retirement, it's important to know what you're able to use your HSA for and what you're not able to use your HSA for. And the list is far too long. You wouldn't even read it if we sent it to you, or if it was on the website. For retirement, you need to know that Medicare Part B premiums and Part D premiums, and if you have a Part C premium, it can work there as well. You can use your HSA for that. Medicare Part B, Part D. You cannot use your HSA for your Medicare supplement plan. And the mind bender on this is your Part B premium needs to be paid from your Social Security. Mm-hmm. So you have to reimburse yourself from your HSA. Your supplement, you've got to pay out of pocket. And so it works the opposite way. But just know what you can and can't use your HSA for in retirement. So, all right. We've got questions from fans of the show. That and more coming up on the Wise Money Show with Korhorn Financial Group. All right. Monologuing there. I was wondering that. I don't think you said anything in the first segment, and I think the third as well. So,
saving all that firepower for the fourth.
Shoot, baby.
That's right. Okay, so I'm wanting to change up the scenario. So we've got several questions about Medicare insurance or health insurance, that sort of stuff.
Can we do something with some variety, like totally different topic, or do you want them to?
No, I would like to have some variety.
Okay.
So do you think Trump tax cuts will continue after 2025, or do you think they'll sunset? Should I do Roth conversions up until then? Is Roth IRA income limit based on your gross income or net income? If I make $200,000 a year, do I pay the equivalent of 4 tax brackets, or am I completely in the 24% tax bracket? So those are the 3 I would suggest. We start with those.
Okay.
Sound good? Kevin?
Yes.
You're going to be doing the entire segment.
I got it.
All right. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. With me in the KFT studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show, as well as a bunch of other content, is on the YouTube channel. Go check it out. Subscribe to it there. Search the Wise Money Show. We've got every episode of the Wise Money Show, these talk shows, but then a lot of other content. Gosh, 5 topics or more each and every week. So make sure you check out the Wise Money Show on YouTube. Subscribe to it. Turn on notifications so you're aware every time we drop new content. All right, we're into the long list of questions from fans of the show. Most of them come on the YouTube channel. We'll start with a question from Jim here. Hey, what do you think? The Trump tax cuts, you think they'll continue after tax year 2025? I'm wondering if I should ramp up my Roth conversions right now, just in case the Trump tax cuts sunset. What's that all about?
You have an opinion on that, Kevin?
I don't know, Jim. That's a great question. There are lots of folks that are looking and they're saying, okay, this is going to impact if you own a business likely, or you have a situation where your net worth is north of $6 million, you're likely going to be looking at federal estate tax issues. And Jim, you're not talking about federal estate tax, you're talking about federal income tax. And I just don't know. So this is where what you have to do is you have to assemble all the data and make the best decision that you possibly can. And I don't know enough about your situation, Jim, to even give you any kind of guidance.
You know, my own personal opinion is that you have to plan as if they are going to sunset, right? I mean, that's what's set in the law. They're going to revert back to pre-Trump laws, and it will result for most people in a pretty significant tax jump, right? And who knows, like what kind of financial condition the nation will be in when that date comes. But man, if you had an opportunity to let taxes increase without having to pass a law to make it happen, No one has to be the unpopular, do the. It's almost political suicide sometimes to have major tax increases on your resume, right?
Right.
But it doesn't have to be in this case. It can just be allowed to happen. And so, to me, what is there are some very favorable tax laws that exist today. And you have to take advantage of them while they exist, because you don't know if they will still exist down the road. In fact, I tend to be in the camp that would say, just look at history and where have tax rates typically fallen. We're on the lower end of the spectrum right now. And if they start to swing back the other direction, we may look back on these years and say, oh man, I wish I had taken more advantage of things like Roth contributions or conversions to pay your tax at these lower rates and avoid it in the future.
Yeah. Okay. So just to set the stage, Trump tax cuts, not my term. That's just what people are calling it. Move tax brackets from 10, 15, 25, and so on, down to 10, 12, 22. And when those were passed by Congress, it was, well, this makes sense today, and we'll put this in place for, X number of years, 10 years. But after that, it wasn't 10 years, 8 years, I think, something like that. But they're going to revert back to how they were unless Congress at the time says, yeah, we want to keep this. Okay. Yeah. And here's the thing, Josh, you nailed it, in my opinion. Well, Kevin, you did too. I can't see the future. So next question. Yes, that's true. But what's the trajectory of our national debt? Pretty big.
I know. I know. So that you could be broken clock right on this one.
I know. So,
because
here's the thing. Politicians, it's still a popularity contest. Mm-hmm. You still want to get elected for your party or whatever your agenda. And so no one, I don't know, no one. It's going to be hard for someone to campaign on, hey, I think we need to raise taxes. But no one needs to be the bad guy in this way, or in this case. Mm-hmm. So I think the odds of having them sunset and revert back, I would put that over 50% as opposed to, well, it's just a coin flip. No one knows. Just a little bit. I wouldn't say, oh, yeah, they're definitely going to sunset and we're going to go back. But I think the odds are.
Even if they don't sunset, then all we'll be saying out there in the future is, hey, great, we still have awesome tax rates. Let's take advantage of these, right?
Right.
So whatever strategy makes sense today, we'll just get it prolonged out there in the future. So I don't know. I'm a fan of letting... we talk a lot about multi-year tax projections. You really can only base your future forecasts on what you know today. There's an infinite number of new tax laws that could be passed out in the future and change the whole game.
Yep,
right?
That's right.
So base your decisions today on what you know today, and we know that today tax rates are very favorable.
Jim, do that multi-year tax projection, work with your CFP, and it's very possible that you should be considering ramping up your Roth conversions. Next question here from Jeff. Is the Roth IRA income limit based on your gross income or your net income? No. I think is the answer. So how does that work, Josh?
Well, so what we're talking about is not everyone can contribute directly to a Roth IRA. Your income each year has to stay under, if you're married, $218,000 this year. If you're single, I think the number is like 138. That's good. Thank you. But this is not all the income that you've earned because you have contributed maybe to a 401k or you have some pre-tax items that are helping to squeeze that number down. And there are certain adjustments that you can make to almost kind of force yourself to become eligible for this. But it's not taxable income after you've taken all of your deductions. This is a modified adjusted gross income, which is pure jargon, but it's a calculated amount on your tax return that is, like, we can look at a line and see this number to determine whether or not you're eligible.
Yeah, I actually don't even think that is modified. I think it's just your...
Straight up adjusted gross?
Yep.
Mm-hmm. So here's the thing. It's not net income, meaning after all of your deductions on your taxes, so what would be called taxable income, but it's not gross income either. it's a little bit strange. We've seen this a lot where you look at what you're earning on your paycheck, and no, it's not that gross number. You get to subtract your pre-tax 401k or 403b, your HSA, those sorts of things, so those pre-tax items. But it's not just your wages that go into this calculation.
Mm-hmm.
Your interest, your dividends, capital gains, any other income, it's all added up and on your adjusted gross income, and that influences whether you're eligible or not. My understanding is, and I don't know all the nuances to this and whether there's any, if, thens, whatever, but doing a Roth conversion doesn't mean, if you do a Roth conversion and that's what pushes you over the income threshold, those adjusted gross income thresholds, that doesn't make you ineligible to contribute to a Roth. There might be some exceptions to that, although I'm not sure. So it's a little bit of both. And so there's the thing, proactive tax planning. If you got a bonus this year, or, spouse goes back to work or whatever, got a second job, I don't know, and all of a sudden your income, it looks like it's going to be above the threshold, contribute more to your 401k. Add some more contribution to your high deductible, your HSA, and that can help. So,
it is modified adjusted gross income, for the record.
Okay. Yeah.
How is it modified?
I don't know. There's a gazillion different versions of modified, right?
Yeah, because I'm on the IRS. It's interesting. You're looking at the news release on the IRS website, and it says income. It just says income, so it doesn't even clarify.
Yeah.
I would have guessed it was modified. Now exactly what's modified or not. Okay, we've got another question in here. I think we can squeeze it in. If you make $200,000 per year, do you pay the equivalent of four tax bracket levels, or are you completely is all of that income taxed at the 24% bracket?
So it's a step. It's basically on a step through. So if you make $200,000, let's just assume you're married. That's easier. If you're not, you can cut these in half for the most part. But on the first $20,000, you're going to pay 10%. Now this is taxable income. So it's on the first 20, it's at 10%. On the next, between 20 and 80, 12%. 80 and 170, it's at 22%.
This is one of the biggest misconceptions about our tax code. When you hear about tax brackets and jumping into the next tax bracket, it's really just that next dollar that falls into the next tax bracket. All the earlier dollars were taxed at lower rates. So you pay tax at a variety of different rates, not just one that you land in.
And that is good news. More complicated, but that is good news.
Nice question,
all right.
G-Bass.
That is all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, all of us at Korhorn Financial Group, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.